The pattern day trading rule is officially dead. The old $25,000 equity requirement has been replaced by real-time, risk-based intraday margin levels. For retail traders with smaller accounts, the gates have been thrown wide open. You can now get in and out of the market 50 times a day without a regulator locking your account. But here is the brutal reality nobody selling you a course wants to admit. The regulatory barrier is gone, but the mathematical barrier is exactly where it's always been. Today, we are looking at the hard science of scalping. Yes, a statistical edge exists. Yes, professionals make millions doing it. But we're going to break down the exact structural reasons why high-velocity scalping remains the hardest way to make an easy dollar, and why, for most retail traders, it quickly devolves into high-speed gambling. Let's clear up a massive misconception. A real scalping edge is not found on a 1-minute chart using retail indicators like moving averages or the RSI. In the world of seconds and minutes, traditional technical indicators lag far too much. They are telling you what happened, not what is happening right now. A professional scalping edge is almost entirely structural. It relies on two things: market microstructure and order flow. Professionals aren't looking at candles. They are looking at the depth of market. They are tracking institutional icebergs, identifying order imbalances, and spotting areas where large buyers or sellers are trapped. They exploit temporary supply and demand mismatches that exist for only a few seconds. And the math behind it flies in the face of standard retail trading advice. You've probably heard you need a 2 or 3 to 1 reward-to-risk ratio. In pure scalping, that is virtually impossible because your targets are too tight. Many elite scalpers actually operate on a negative risk-reward ratio. They might risk 2 points to make 1 point, but they combine that with a highly disciplined 70% to 80% win rate. That is how you generate positive mathematical expectancy. If you don't understand order flow to secure that high win rate, you aren't trading an edge, you're just guessing direction. So, if the edge exists, why do most retail scalpers fail? It comes down to 3 unavoidable market frictions that stack the deck against you. First, the bid-ask spread drag. Every time you enter a trade by hitting the market buy or sell button, you cross the spread. You start every single trade in the red. If you are targeting micro gains, that spread acts as a massive compounding tax on your account. Do that 30 times a day, and you are bleeding capital just to participate. Second, the latency gap. When you scalp, you are stepping into an arena with high-frequency trading algorithms. These HFT bots are hosted on servers physically located inside the exchanges in Chicago or New York. If you are using a standard retail platform, pointing and clicking with your mouse over a home Wi-Fi connection, you are thousands of milliseconds slower than your competitor. If a bot senses an order imbalance, it will front-run your fill before your platform even updates your screen. Third, payment for order flow, PFOF. Those zero-commission retail stock and options brokers aren't free. They make their money by routing your orders to wholesale market makers. This means your execution fills are often a fraction of a cent worse than direct-to-exchange routing. For a swing trader, half a cent doesn't matter. For a scalper trying to capture 2 cents, it's fatal. So how do the professionals make a living doing this? First, they don't use retail setups. Professional scalpers at proprietary trading firms use direct market access, or DMA, platforms like Trading Technologies or Laser. Their orders go straight to the exchange routing books, completely bypassing the wholesale middlemen, and they pay institutional commission rates. Second, they usually don't scalp equities or retail options. They trade futures markets like the E-mini or micro Nasdaq and S&P 500. Futures offer a highly centralized, transparent order book where everyone sees the exact same data at the exact same time. Plus, they offer massive leverage without PFOF nonsense, and they come with favorable Section 1256 tax treatments. But the final, most dangerous friction isn't mechanical. It's biological. Scalping requires intense, hyper-focused psychological discipline for hours on end. In this game, a single second of hesitation or a brief flash of revenge trading can turn a controlled 2-point stop loss into an account-destroying drawdown. You are competing against machines that don't get tired, don't get angry, and don't hesitate. The abolition of the PDT rule is a massive win for trader freedom. But freedom without execution discipline is just a faster way to blow up an account. If you want to scalp, stop looking at indicator strategies on YouTube. Start studying market microstructure, look into the futures markets, track volume profiles, and build a system with a verifiable mathematical edge, all of which is very difficult to do for a retail trader. If you want to know what strategy I'm using to profit from the markets, utilizing the safest method I've discovered after over a decade of trading, you can join my Patreon group for free. The link is in the description box below. Let's trade systematically, stay disciplined, and I'll see you in the next video.